Hello, I'm Clara Hermit and this is Mould on Markets. It is our look at the financial markets with our investment research director, Russ Mould. Russ, how are you?
Very well, Clara. How are you?
Not too bad
Good.
at all. So we're here now, the sun has disappeared.
Yeah.
What is it that advisors and their clients should be thinking about?
Well, I think the big issue still remains, and I know I sound a little bit like a cracked record, it is still down to central banks. They still have centre stage. It's getting a little bit frustrating for everybody, but it's the way the market's acting, so advisors and clients need to be aware of that. We've had the Jackson Hole loving in Wyoming. Some interpreted it as a little bit hawkish. Most came out thinking it was very, very dovish. But net, the debate still is, when will interest rates start to go up, at what speed, and what does the great normalisation trade actually mean? Now you can see behind us from this chart, looking at base rates in Germany, the UK, Japan and America, we're at historic lows. So in principle, there's only going to be one way they can go. It's just a matter of how fast. And my personal suspicion is, not terribly.
Yeah, I mean, well, you've just touched on it. It does seem like there's only one way they can go, and that is up.
It does. I guess the issue there is, though, however, are the major economies really tearing up trees? I mean, we've had 5 years of phenomenal amounts of monetary stimulus, and we're still growing at fairly sub-trend levels. I know there's been a lot of fiddling of the GDP statistics, so the UK economy is now bigger than it was 5 years ago. But it's difficult to argue that if you didn't start to withdraw a lot of that stimulus, things would roll over quite quickly. And also, don't forget, governments are still incredibly indebted. They can't really afford a big increase in their own borrowing costs, let alone worrying about companies or consumers. So again, I suspect you will get a very, very slow increase, assuming there's one at all. But I think what you will get is a lot of jawboning, as you saw at Jackson Hole.
Mm-hmm. So can we expect more forward guidance, or at least new versions of it?
Yeah, because the forward guidance wasn't a ripping success, given that they kept on moving the goalposts. But I think you will get a lot of central bank talk to keep the bond vigilante sweet and at the same time try and keep the economy jubbling along as best they can. I mean, there are two precedents that clients need to be aware of here, 1994 and 1937. Trust me, I'm a history graduate, okay? So first of all, let's look at 1994. And one of the charts, we've got two charts coming up here. In 1994, under the US Federal Reserve, Alan Greenspan jacked up interest rates without telling anybody, from 3 to 6% over a 2-year period. The first move caused absolute panic. Equity markets rolled over, bond yields spiked, and actually Mexico contrived to go bust in the process. Now, as you'll see from the chart behind me, the first one shows the US S&P 500 and the 10-year bond yield. The second one shows the UK and the 10-year bond and the FTSE All-Share. And as you can see, 1994 wasn't a brilliant year. But the panic didn't last very long. Economic strong fundamentals took over, earnings growth took over, and markets bearing a quick wobble in 1998 were off to the races.
Okay, so that doesn't sound too bad.
Not at all, no.
What's the second precedent?
Yeah, that was 1937 under Roosevelt rather than Clinton. That's an awful lot less fun. Now, the data's so old, actually finding a chart I can show that visualises it's quite tricky. I'm going to keep trying. But what you've got to bear in mind here is that the Fed actually began to launch QE in late 1936. Now, I know at the moment it's winding it down, but the market took the view that monetary policy was going to be too loose for too long. With the result, again, bond yields spiked. The market didn't wait for the Fed to back off, it just got on with it anyway. And in that situation, the Dow Jones Industrials actually halved and a recession followed very quickly. So that's a much less encouraging a precedent, and it does show why you've got this balancing act that the central bankers are trying to do of keep the bond vigilantes happy on one side by saying, yeah, we're going to do something, we're worried about inflation, while on the other side, try and keep the economy moving forward.
Okay, thank you, Russ.
Thank you.
We'll see you next time on Mould on Markets.